Welcome to our 2016 webinar series. This year, timing is everything. This year, we'll be telling your clients stories just when you need to hear them and share them with your clients. After all, when you tell a story, it makes all the difference. If I told the story of the three little pigs to a group of 5-year-olds, it would be a fable. If I told the story of the three little pigs to a group of general contractors at a summer campfire, three little pigs to a group of general contractors at a conference, it would be a case study. If I told the story of the three little pigs at a summer campfire with a bunch of preteens, it would be a scary Cujo story. And if I told the story of the three little pigs on a first date, well, there probably wouldn't be a second date. Each month we'll tackle fears your clients have about income security and wealth preservation using innovative and creative insurance solutions. This month will highlight disability insurance in recognizing May is Disability Insurance Awareness Month. Each month's series will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's story is being recorded and will be posted on our website within a week in case you have missed any of the plotline. And throughout 2016, like the saying, the more you read, the more you know. The more you watch, the more CFP CE credits you'll earn. You can earn 8 credits, 1 for each month. Today's storyteller can tell you dozens of stories, constantly monitoring disability insurance and ensure your clients are getting the most up-to-date solutions. She joined LLIS in 2005 and has paved her way to covering various types of insurance, disability insurance, and critical care insurance. And now, to tell the story of how disability insurance can insure your client's paycheck, Kathy Bilodeau.
Thank you, Claudia, and thank you to all of you for joining me this afternoon. Today, I hope you learn a little bit about disability insurance and you take away something that perhaps you could use with your clients in the future. But most of all, I want you to remember one thing and one thing only: my name and my phone number. If a question should come up about any type of disability or critical care, just remember to call me. So let's get started. Now, I know most of you have seen this slide in the past. It's one of my favorites. And if you were to sit down with your client and ask them what do they believe to be their most valuable asset, they might say, well, I think it's my car, I think it's my house, I think it's my boat. But the true reason, or excuse me, the true asset is really their income. Their income is what allows them to pay for all those things. If something were to happen to that income, their whole house of cards would fall down, their whole financial house. But if they had a disability insurance plan in place to replace that lost income, guess what? They'd be able to pay for that disability insurance policy, the life insurance policy. They'd be able to put money away for retirement. And for your business owner clients, they'd be assured that they'd be able to keep that business going. So it's important to realize what a client's asset, the client's asset of their income is with regard to their entire financial plan. So before we get started, I think it's important that you know that 1 in 4 20-year-olds will become disabled before age 67. And did you know that the chances of a 40-year-old having at least one long-term disability in their lifetime is 45%? And contrary to the belief that most disabilities are injury related, they're actually not. Most of them are illness related. So disability insurance is often called income replacement insurance, and a lot of people think, well, what exactly does that cost on a monthly basis? Well, if you were to look at your client's Netflix bill, it'd probably be running them about $16 a month. If they have any type of wireless service for their computer, it's probably running them about $30 a month. And just about everybody has either an iPhone or a smartphone, and that service is probably running about $70 a month. And for all of us who have any type of internet service, we're probably paying upwards of $80 a month. But guess what? A disability income replacement plan is about $19 a month. So you can see in relationship to all these other probably not luxuries, but necessities, disability income protection is extremely affordable. Did you know that the #1 reason for early retirement is due to health issues, and that 1 in 8 individual workers will be disabled for 5 years or more during their career? And 31 months, that's the average disability claim. How many of your clients could go without an income for 31 months? Let's see. Hang on. And Social Security. We all think that our clients are going to rely on Social Security disability. That's usually their pat answer. Oh, I'll just apply for that. And 46% of those people that actually get a disability benefit are only going to receive about $1,000 a month, okay? Now, something to keep in mind for their clients who are going to be relying on Social Security is 40 of that 46%, you have to keep in mind that 65% of claims for Social Security disability get denied. So most of the time, if they want to get approved, they're going to have to hire an attorney. As a matter of fact, I was listening to a webinar the other day put on by a disability insurance company, and the presenter said that part of the problem with Social Security disability is the fact that no one practices purchasing private disability insurance. In other words, they're just going to rely on Social Security disability. And if that's the case, then we're all going to be. Claudia, are you there? Because I keep getting this pop-up. No more attendees. I'm
I'm
sorry.
here.
I keep getting a pop-up box that says no more attendees, that we've reached the maximum 101.
I think we can just ignore for the moment. I don't see your screen.
Okay, all right. I just keep having to click out of it. Like it just came up again, no more attendees allowed. Someone was not allowed to enter the webinar because it's full, a maximum of 101.
Just continue. I'll get Dave.
Okay, all right, thank you. Sorry, all of you. But in any event, what he ended up saying is if you don't plan for this, in other words, if you don't have a plan B, then what are we going to do? Are we just going to rely on Social Security disability? Are we going to have a bake sale, or are we going to use GoFundMe? Those are not really good plan Bs. And if you tuned in today's newsletter, we talk all about plan B. So let's get started. The first thing that we're going to talk about today is how to provide your clients with individual disability plan. Then we're going to provide discounts for those clients. Yep. It's freezing me up. Okay. Then we're going to talk about some business solutions for your business owner clients. And then for those clients who may not have an earned income to replace, we're going to talk about critical care insurance. So first of all, let's talk about disability insurance. What does it do? Well, first of all, it provides a safety net. It provides a monthly paycheck. And most importantly, it provides peace of mind. So how do underwriters determine who's eligible for disability insurance? Well, the first thing that they look at is your client's income. They're going to look at their base, they're going to look at if they generate a bonus, or they're going to look at commissions. All these are insurable. They're also going to look at unearned income. Unearned income are things such as rental property, investment income, royalties, trust income, things like that, where you end up having your benefits limited if you have too much unearned income. The reason for that is simply because it continues to flow to your client whether they're disabled or not. The good news is we just got an announcement from one of our carriers that they will no longer take unearned income into consideration. So if you have clients that have some unearned income, let us know, and we will probably use that one insurance company, since we now know that won't be an issue with them anymore. Now, the second thing that insurance companies look at is occupation. And on this particular situation, you can have an occupation class from a B to a 6. Baggage handler would be a B, your attorney would be a 6. The reason this is important is because insurance companies need to know what your client is doing on a day-to-day basis. What kind of duties are they performing? For example, if your client was a baggage handler and they suffered from some sort of, let's say, a physical or some sort of illness that prevented them from being able to work, chances are they would not be able to work in any capacity. Being a baggage handler, window washer, they're just not going to be able to work. But if your attorney, let's say he had some sort of injury and he was still able to go to work on a computer and do some other things, he would still be able to work in some capacity. So the likelihood of them having to pay a claim is a lot less. Now, some of the things that they take into consideration are, what is the financial situation? What kind of income is your client generating? What are their day-to-day duties? In other words, are they more manual versus more office? What is their environment? Are they working in an environment, or are they a construction person working on a high-rise that's under construction? And education. The higher the education, the greater the likelihood that your client is probably going to want to make their way back to work. So if you have a doctor, you have a dentist, you have a veterinarian, you have a scientist, they've paid a lot of money and they've put a lot of time into their occupation. So they're going to want to make sure that they can get back to work, even if it's on a part-time basis. Okay? And then the last thing is health. Now, with life insurance, the thing that they're concerned about is mortality. With disability, it's morbidity. Mortality with life insurance simply means is what's the likelihood of the client dying too soon or dying early. With disability, they're looking at morbidity. Someone that might have, say, diabetes or high blood pressure or high cholesterol, or they're overweight. Any one of these things could put them out on claim, but when you have a combination, there's a greater likelihood that they might go out on claim. Now, with with life insurance, they can ask you to pay a higher rate. With disability, they can just decline you. They're just not going to cover you. So a perfect example is, let's say you have a client who applied for life insurance and they have some sort of vision problem, and there's a likelihood that they might lose their vision some point in the future. Chances are that's not going to affect their life insurance, but with disability, they would probably be declined because there's a greater likelihood that they would go out on a disability claim. In addition, with disability, they can put exclusions on. They can put ratings on. They can limit the benefits. They can increase the elimination period. They can do a lot of things to still issue your client a policy as opposed to declining them. Okay, and this is just freezing me up here. Okay, so let's dive into individual disability plan. First and foremost, the base monthly benefit. That's the amount that your client is going to receive in the event that they become disabled. The elimination period is the period of time that your client is still disabled, but they're not receiving any benefits. In other words, they're self-insuring. We traditionally use a 90-day elimination period because most of the advisors that we work with recommend that their clients have approximately 90 days of emergency cash available to them. Now, benefit periods. Benefit periods can vary from 2 years to age 65, age 67. We even have some going to age 70. The reason you have the lower benefit periods is a couple reasons. One, that baggage handler, that window washer, they're not going to get an age 65 or an age 67 benefit period. They're going to get probably a 2-year or 5-year benefit period. Additionally, if someone has some sort of medical condition, chances are they're not going to get an age 65 benefit period. They're going to get maybe a 5-year benefit period. We see that a lot when your clients are on mental or anxiety or depression medication. They're going to put a mental nervous exclusion on the plan, and then they end up having a 5-year benefit period. And then riders. We traditionally will add the future increase option rider, the residual rider, the COLA rider, cost of living adjustment rider, and the catastrophic rider. So let's go into greater detail about what these riders are. The first one is the future increase option rider. This is the rider that allows your client to increase their monthly benefit as their income goes up. Now, the great thing about this one is simply because there is no medical underwriting. So as your clients getting a higher salary, getting bonuses, getting commissions over their career, you want to make sure that the monthly benefit is keeping up with that. So what we're going to do is we're going to reach out to them usually on an annual basis and see if they've had an increase. We run quotes and then we get those increases affected on their current policy, or we spin off a new policy. The second is the residual rider. This is the rider that allows your client to work part-time. If this rider is not on the plan, and if their doctors haven't deemed them totally disabled, then they wouldn't be able to collect benefits. This is kind of like a safety net. This says that if your client goes back to work in their occupation or any occupation and they're losing 15% or more of their pre-disability earnings, they're going to be eligible to collect a portion, if not all, of the benefits from their disability plan. The next one is the cost of living adjustment rider. This is the rider that kicks in when your client is on claim. This one's really important because if your client took out a policy for $5,000 when they're 30 years old, and if they unfortunately go on claim that next year, you don't want that $5,000 to remain stagnant all the way to age 65. What the cost of living adjustment rider does is we usually use 3% just because inflation hasn't been that great. And we add that to it, and it's increased every year, compounding on the anniversary date of your client's policy. And what it does is it helps with the increases of perhaps food, utilities, everyday living expenses. This will help offset those costs when your client is on claim. And then the last one is the cat rider. Yeah. This one, I usually explain it in 3 different categories. This is a monthly benefit that is paid in addition to the base benefit. And lots of times it can get to almost 100% of their pre-disability earnings. The purpose of the catastrophic rider is simply to, what's the word I want to use? It's simply to offer additional dollars to your client in the event that they're catastrophically injured or suffering from an illness. Now think of it as 3 different categories. The first one I think of as being a cognitive brain impairment. So if your client suffers from a brain injury, they stroke out and they're cognitively impaired, they're diagnosed with dementia or Alzheimer's, they're automatically going to be eligible for that additional benefit. If your client, if you're familiar with the activities of daily living, if your client loses 2 or more of those, like bathing, dressing, toileting, transferring from bed to chair, eating, continence, if they lose 2 or more of those, they're automatically going to be eligible. And then the last category is more of a physical one. This one says that if you actually suffer the loss of an arm and a leg, or both arms and both legs, or you suffer the loss of use of those. If you lose the vision in both eyes, hearing in both ears, or the ability to speak, any one of those is a trigger to get the additional catastrophic rider. The purpose behind this is chances are your client is not going to be able to work in any capacity. They might need to have someone come into their home and help take care of them. And additionally, they might need to make modifications to their home. So the catastrophic benefit helps to offset those additional costs. Now, something that LLIS does is we provide a free policy review to advisors for their clients' benefit. And this is some of the information that we need in order to perform that policy review. And the reason we ask this is sometimes when we get done with the policy review, we realize that, one, the policy that they have is really not relevant now, or it's just not adequate and we might need to replace it, or we might need to layer on another policy on top of it. And when we have all this information up front, we can make that determination. Lots of times with disability, we don't recommend replacing because insurance is going to be that much more expensive. So lots of times we will just say, why don't we layer over the additional or add to the additional coverage or the original coverage. So when your client has disability through an employer, like we have John here, and you sit down with them and you're looking over everything and you ask the question, so John, tell me, do you have disability coverage? And John says, oh yeah, we don't need to talk about that. I got it at work. I'm completely covered. This is where it's really important for you as a financial planner to say, whoa, 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 whoa. We need to dig a little bit deeper. I need to know exactly what you have to make sure you are adequately covered. So with John, you know, he says, I have group coverage, I'm perfectly fine, don't need to do it, but you say, you know what, let's take a look at what you have. So John's making $100,000 and you realize that you're looking at his plan that he's got 60% of his base salary, not including bonus or commissions, and there's a cap of $5,000. So if he's making $100,000, that's $83.30 a month, and you multiply that times 60%, that's $5,000, okay? But his employer's paying for the group coverage, so that means it's taxable. So you really have to take into consideration that when your client is out on claim, yes, he's going to get the full $5,000, but at the end of the year, he's going to get a 1099 for that disability benefit paid for by his employer. And there's going to be different definitions. The elimination period is usually determined by the insurance company or by the employer. Non-cancelable, this is not necessarily true with, with being non-cancelable. Let's just put it this way. The employer can actually cancel it and say, hey, look, revenue is down, we need to cut back, or the insurance company can actually cancel it. And lots of times the only riders that are available are residual and portable. Sometimes it is and sometimes it isn't. So lots of times when your client is leaving a group and they make an inquiry as to whether they can keep the insurance, sometimes it's no, it's not offered at all, and sometimes it might be yes, but it's not the exact same plan. It might be, okay, we'll offer you coverage for $4,000 a month. It's not a 60% thing, it's just a specified amount. So you got to look really close into that. So what we found out when we were looking at John is he actually had what we call a gap. So this is how you, as a financial planner, can identify the gap with us or with our help. So his monthly gross income at $100,000 is $83.33. His take-home pay is $62.50. Now, we just talked about his group disability. It's 60% to $5,000, but it's tax. So in essence, it's really $37.50. So when we look at all these different pieces, we realize that he's got a gap of about $23.25. So we're able to provide him, because of the fact that we're covering his commissions and his bonus, we're covering the taxable benefit that he has. This is where the $23.25 comes in. And this is a tax-free plan because he's going to pay the premium with after-tax dollars. So his take-home pay is about $62.50. When you combine the $37.50 that he's getting with his employer with the $23.25, that's about $6,075, which is about 97% of his after-tax benefit or his after-tax take-home. Okay, now some of you might be asking, well, why are we only getting 97%? The reason behind that is you're never going to get 100% of your income because there's no incentive for your client to ever go back to work if we pay them 100%. Okay, so let's look at this a little bit closer. We have John Group and we have John Supplemental that we just sold him. So the group is going to give him $5,000 a month, hypothetically. The individual is going to pay him $23.25. After taxes, because it's an employer-paid benefit, he's only going to receive $37.50, but because he's paying for the individual with after-tax dollars, he's going to receive $23.25. The definition of disability on a group plan is generally any occupation, depending upon the type of employer if it's a CPA or an attorney, they might have an ONOC for 24 months, but most of the time it's ENEOC. The difference between ENEOC and ONOC is most people say, well, when it says ENEOC, does that mean I have to flip burgers at McDonald's and I'm going to be a greeter at Walmart? Not necessarily. Most of the time, any occupation means that your client might be asked to do something that would be considered beneath them. So let's say an example would be an attorney. An attorney could be asked to work in the copy room, believe it or not, make copies. He's still in an office environment. He might be, filing, just doing some sort of office work. Own occupation is completely different. Own occupation is the most sought after. It's the most comprehensive definition. Own occupation means that if your client cannot do the substantial and material duties of their occupation, and they choose to, those are the operative words, choose to, they don't have to, but if they choose to work in another occupation, they collect 100% of the income from their new job plus 100% of the benefits from their disability policy. Okay, so that's why it's so strong. That's why you have to pay for that rider. And that's why we find that doctors and dentists and scientists and veterinarians and CPAs and attorneys really want that definition. Next is the elimination period. Usually the employer or the insurance company that the employer is using to supply the group plan determines what the elimination period is. Individual, you can actually choose it, but like I said before, we generally say 90 days, but you can go down to 30, you can choose 60, you can choose 180, you can choose a year, whatever the case might be for your particular client situation. And then non-cancelable. We talked about how the employer or the carrier can cancel it. Almost every plan that we offer is non-cancelable and guaranteed renewable. What that means is as long as your client continues to pay the premium, they cannot cancel it for any reason. In addition, they can't raise the rates for any reason unless they affect the change. So those are key things to have in the individual plan. And we talked about whether it's portable or not. On an individual, it will follow you wherever you go. You can change employers, you can change states that you're living in, and the policy continues. And then again, the rider options. We talked about all the different rider options you can put on the individual. Normally with group, you'll see residual, sometimes you'll see COLA. But other than that, not a lot of options. Now, I know all of you are always asking, we like case studies, we like case studies. We're always getting feedback from that, from webinars and from Academy. So I want to tell you, I have put together what I feel to be some of the most interesting case studies, and I think they're kind of a variety of scenarios, and I hope you can learn something from these, okay? So our first one is Sally. Sally came to me about a year ago, and she was a biomedical engineer, still is, and that's an occupation class 6. And the reason she came to me is her financial planner said, she's working for an employer, but I believe she might have a gap in her group coverage. So could we run some quotes? And we determined that she was eligible for about $21.70 of monthly benefit. And like I just mentioned, we put the future increase option rider on there, we put COLA on there, we put CAT, and we put residual on there. And Sally was 36, so her premium is about, at the time, was about $28.10, okay? And she was happy because she knew that, that this particular policy was going to cover the gap. But she called me in February of this year, and it just happened to be right around the anniversary date of her policy. But had it been somewhere later on in the year, like August of this year, we still would have been able to help her. What she did is she quit her job and she started a new job where she's making more money, but the employer wasn't offering any disability coverage. So she said, what can we do? And I said, you know what? You've got almost $4,000 of future increase option on your plan. Why don't we run a quote and see what you're eligible for? And actually she had more than 4,000. She had 4,300, but she was eligible for 39.60. So I ran a quote for her. We put the residual and COLA on there. And so now with her original policy of 21.70 plus the original 39.60, she now has a monthly benefit of 51.30 which she feels a lot more secure knowing that if something were to happen to her, she has adequate coverage to pay her bills. So her combined premium now is about $44.82. Now, my second case, this one's really off the beaten path here, but Jeffrey came to me 5 years ago, and he was working for the Department of Justice, and he's an attorney. And for those of you who don't know it, when you work for the federal government employees have what is known the FERS program. The FERS stands for the Federal Employee Retirement System. Within the FERS program, they have a disability plan that provides 60% to the employees, 60% of the employee's income the first year they're out on claim, and then thereafter it's 40%. So he needed a little extra. So we provided him with $5,000 of, okay, why isn't this working? $5,000 of monthly benefit, and we put the COLA, the CAT, and the residual rider on there. He wasn't interested in the FIO. We talked about it, and his premium was $18.58. Now, for some reason, things went along fine for the last 5-6 years, and then in January of this year, I got notification that Jeffrey decided to cancel his policy. Now, keep in mind, one of the things that I do here at LLIS is I work every cancellation, I work every term. If someone wants to terminate or cancel their policy, if someone's late paying their premium and there's a lapse notice, I work to find out what's going on with this. Well, for some reason, Jeffrey didn't call me, didn't contact me, didn't contact the advisor, and decided to just cancel his policy. So when I tried to contact him, I tried to contact the advisor, I wasn't getting anywhere. Finally, I just kept leaving messages, and Jeffrey finally got a hold of me, and he says, well, I didn't think I needed the coverage anymore. And I said, well, what's changed in your life? Are you still working for the Department of Justice? Yes. You're still under the FERS program? Yes. You still making X number of dollars? No, I'm actually making more. And I said, so what made you think that you didn't need this anymore? He said, Kathy, I don't know. He said, I made a big mistake. Could you reinstate me? And I said, Jeffrey, unfortunately, it's too late to reinstate. You cannot reinstate a policy that's been canceled. So here he had his $5,000 monthly benefit, he had COLA, and he had residual, and as of April, he doesn't have it anymore. The reason being is when you call and you cancel a policy, and he even went so far as to ask for a refund in the premium, it's over, it's done. It's not like a policy that's lapsed and we're trying to reinstate it because you overlooked the premium payment that was due. So I told him, if you're still interested, we could still get you some insurance. So what we ended up doing is we are now applying for a new policy, and his premium has gone up because now he's 5 years older. So he was paying $18.58. He's now paying $21.32 for the exact same policy. So because he didn't call me, he's now paying $275 more a year for the exact same disability policy. So moral of the story is call me. My next story, Alex, this one has a much happier outcome. Alex came to us in March, and he's a research engineer, also Class 6. We're kind of on a roll here with them. And he was working for Samsung, and he needed some additional coverage. And so he was eligible for about $3,900 of benefit. And so we ran the quote. And again, we mentioned all the same riders, FIO, the COLA, the CAT, and the residual. And the premium came out to be about $13.73. The bad news was, right in the middle of the underwriting process, or right before we were going to submit his application, Alex called me and said, Samsung has laid off a whole bunch of people, and unfortunately, I'm one of them. And he said, what do I do? And I said, well, Alex, unfortunately, we cannot process your application because you don't have an income to replace. I said, but if you feel like you're going to be employed soon, what we could do is just postpone the application, and then we could activate it again once you find a new job. Well, the good news is he was able to secure another job in less than 6 weeks, and what ended up happening is he got better coverage through this employer with regard to his group coverage, so he didn't need nearly as much of monthly benefit. So he went from a $3,900 down to $2,450. We still put all the same riders on, and his premium that was going to be $1,373 is now $927, and he's happy because, again, he got adequate coverage to pay his bills, felt secure, and obviously he's happy because he got another job too. Um, but you can see where, we were still able to meet his need and save him some premium. Now this next case is Martin. This one is one that I think is kind of extraordinary. Again, Martin came to me 5 years ago. He's a librarian, so he works for, I believe it's the county, and he has an occupation class of 4A. Well, what happened with him is he told me about some medical conditions that he had, and I said, Martin, unfortunately, I ran this information up to several different underwriters, and no one's willing to cover you through our traditional carriers with a traditional plan. I did find a carrier who'd be willing to give you a graded plan. I said, it's not going to be for very much money. It's about $2,000. I said, we're going to have to use some Social Security disability rider, and they're not going to give you an age 65. It's going to be 5 years. And I said, it's graded. Now, a graded plan we use for people who have really unusual occupations. They might have some health issues. But what it says is we're willing to take a risk and cover you, but you have to earn the benefit. So the way this worked for him is when he took this policy out in 2010, if he went without a claim for the first year that the policy was in force, and he went out on claim during the second year, he would get $350 on the base and $367 on the Social Security side. If he got through the second policy anniversary without going on claim, he would be eligible for $700 a month and $731 on the Social Security. And then if he got through the third anniversary, which he did, of the policy, then he would be eligible for the full $2,050, God forbid if he went out on claim. This was not an inexpensive policy. As you can see, it's $2,033 a year. So with his medical conditions, one of them was colitis. He also had a pilonidal cyst. None of these were going to go away anytime soon, but I told him if you can get it stabilized and if you can get through these first 3 years, maybe we can improve upon it. So the good news is we reached out to him earlier this year, actually about a month ago, and he said, yeah, he goes, I'm still on medication, but I haven't had any flares. Could we look at possibly getting a better policy? So I sent an email up to the underwriter with the exact same insurance company, but an underwriter on their traditional side, and said, hey, here's his situation. Is there any way that we could get him an age 65? Can we get him some riders? Can we get him, some more coverage? He's making a little bit more money. And they looked at the information and they said, yeah, he went pretty well without any claims on the graded plan. We'd be willing to take a look. Obviously, we're going to look at his medical records. So I came back with the good news after running the quote that he's eligible for $3,000 more of monthly benefit. He can get to an age 65 benefit period. We could put the residual rider on there, and guess what? Look at this premium, folks, $1,444. So you talk about getting more bang for your buck. He's saving $589 a year just because we were able to improve upon the plan, and from a medical standpoint, he was stable. So never underestimate what we can do with regard to your client's situation. So we talked about how to provide your clients with individual disability plans. Let's see if we can't save them some money by providing some discounts on there. And for those of you who were tuning in to their emails today, you would have gotten a copy of the LLIS Policy Matters newsletter. Some of the things that we're talking about today are outlined in there in greater detail, and I know for a fact one of them is discounts. So if this is a little confusing to you, make sure you read the policy newsletter, okay? So first of all, multi-life discount. The multi-life discount can provide your business owner clients or people who work for the same employer a 20% discount. This is 3 different lives actually working for the same company. The underwriting is unisex, so for us females who pay more for disability than men, that kind of levels the playing field. And the discounts are available for one employee. So let's say you have let's say it's a company that has 10 employees, and John Doe wants a disability plan, and he applies for disability, and then he convinces two more of his colleagues to apply for a policy within the same year. What's going to happen is John Doe is going to get a 20% discount retroactive on his policy, and the two other employees are going to get a 20% discount also. The nice thing about these is both John Doe and the two other employees, if they leave that employer, because these are individual plans, the employer is not paying the premium, um, they can take those policies, leave the employer, move across the state, and they get to take the policy and the discount with them. It follows them wherever they go. Okay, so to make this a little clearer, this is a case utilizing the 20% discount. So we have a CPA firm. We have Lee, he's 45, he's earning 175, pays himself a $25,000 bonus. He has Lisa, she's also a CPA, she's earning about 150 and she earns a $15,000 bonus. And then we have Lois here. Lois is our junior CPA, recently started with them. She's making about $50,000 and has a $7,500 bonus. So Lee purchases a policy that has a 65 benefit period, 90-day elimination. He's eligible for about $9,500 in benefit. We're going to put the COLA and the residual on there. Now, without the 20% discount, this is going to run him about $4,800 a year. With the 20% discount, plus you can actually add another 10% if you say, I don't want any kind of mental nervous covered beyond 24 months. So in other words, if you suffer a mental nervous claim, they'll pay it for 24 months and then you're on your own. So we did the same thing. He's saving about $1,460. And then with Lisa, and you don't have to all have the same plans. Like if Lisa didn't want to pay for an age 65, she said, well, you know, money's a little tight. I want to see what a five-year benefit period is. You can customize these. These are all individually designed. Excuse me. She went ahead with the $7,800. We put the COLA in the residual. Before the discount, hers was about $3,800. We put the discount on, and she's saving about $1,143. We did the same thing for Lois. Again, Lois, she wouldn't necessarily have to have the age 65 benefit period. She might not do the full monthly benefit that she's eligible for. We could lower that down. We could reduce some of the riders, but her premium was only $955. Remember, she's young. She's 27 years old. With her discount, it's about $670, and she's saving $286. Now, conceptually, so that you can kind of see what this looks like across the board, you have the premium before, the premium after, and the premium with the savings. So all total, it would have been $9,600 for the whole group, or for the three of them, $6,700 with the multi-life discount. That's almost a $3,000 savings. So you got to keep this in mind. You know, I do bring this up sometimes when we have a doctor's practice, we have a dental practice, or, you know, we have residents who are all going to the same school or something like that. You know, just kind of think of it. If you're not sure, call me up and we see if we can, you know, apply that discount. Now, another one is the affiliation discount. This one can save your client's premium too, but it's a 10% discount. So if you have 3 family members, you know, all obviously in the same family, all working, we could provide them with a 10% discount. If you have 1099 contractors, lots of times we'll see, I got a client who does, what do you call, remodeling and renovation, and all his contractors are 1099. And he's got 12 of them. This would be a perfect opportunity where we could go in and provide a 10% discount for disability on those individuals. And then the multi-life that we just talked about. Let's say we had Lee didn't apply for it, but his wife wanted coverage. We'd be able to provide her with a 10% discount. And then lastly, I see this mostly where we've used it is with Chick-fil-A. Any kind of franchise or small business owners that are all under the same recognized franchisors can get a 10% discount. So keep that in mind. You know, again, certain niches for these particular discounts. So we talked about providing your clients with individual disability. We talked about trying to save some money. And now we're going to talk about a topic that is really, really important if any of you have business owners, clients. What you'll learn in this portion of the presentation, I believe, are some of the topics you should be bringing up with your business owners. But before we get started, I wanted you to know that there are 28 million small businesses in the United States. And of those 28 million businesses, 54, let's see, and those 28 million businesses account for 54% of all U.S. sales. Additionally, 20% of those small businesses have life insurance and only 18% have disability insurance. All the more reason to get involved and make sure that they have adequate coverage. Now, this I think is a very, very important slide. The reason being is because growing businesses, which are considered businesses that are 10 years or younger, like my little pup here, versus an established business, which is 10 years or older, what they found is growing businesses, those business owners took it upon themselves to make sure that they had business protection. 50% of them versus 25% of an established business owner. Additionally, these young business owners also made sure from an individual standpoint that they had some sort of disability protection in place, 37% versus 23%. What this means is that financial planners are working more with these growing business owners, and they're telling them that they need to make sure that they have adequate coverage both on the business and on the individual. So don't leave your clients out in the rain not well protected. Instead, give them the very best protection available. Go Rays, go Bolts. Next. This is an interesting slide because I think it's one that makes you realize about the likelihood of disability over death. Here's some interesting statistics here about what the ratio is of a client becoming disabled before dying at age 65. The reason this is important is because when you look at the information on the right here, you have to realize that individuals that used to die from heart disease or cancer or cardiovascular, because of medical technology and the medical care that they're getting, they're not dying anymore. They're living, but unfortunately the quality of their life probably is not one that allows them to go back to work. So the greater the likelihood of them being disabled. So that's why it's important to make sure that your business owner clients have adequate coverage. So the first protection that we're going to talk about is business overhead protection. Business overhead protection reimburses the business owner for business expenses. Usually when we look at these plans, the elimination period is shorter, 30 days versus 90. You want to make sure those expenses are getting paid right away. You don't want to leave the rent, you don't want to leave the utilities, you don't want to leave the employee's salary waiting. You want to make sure that those expenses are getting paid right away. Second of all, the benefit period is shorter. If the business owner isn't back within 2 years, chances are they're not going to be back at all. So we usually use a 2-year benefit period. Now, business overhead, like I said, is usually used to cover rent, taxes, insurance, any kind of payroll. Secondly, what's not covered is the business owner's income. The business owner's income is covered by their individual disability policy. And what the business overhead insurance does is it covers the operating expenses. It provides continuity of business, so when that business owner comes off claim, they have a business to come back to. It provides goodwill not only to the employees knowing that this plan is in place, but also to the vendors and to the clients, and it retains the business value. So here's Patrick. He's an internal medicine physician that came to me, and he was interested in getting some business overhead for his expenses, and so we were able to provide him with a benefit of $10,000 at $1,700. This is an example of some of his expenses, and his share is about 25% or $10,000. So that's what a business overhead plan does. Now, the second protection is business loan protection. This is ideal if you have a client, a business owner who's taken out a loan to perhaps expand their practice. What this does is it reimburses them for the business loan. So they pay it, they get reimbursed, they use that money, and they make the next loan payment. So the reason this is important is the Small Business Administration has given out over 23 million loans valued under $1 million with a combined total of 587 billion. The average SBA loan is about 371,000, and bankers are refusing to lend out money if a client doesn't have $2 million in revenue. But the good news is there is protection called the Business Loan Protection Rider. It helps to secure a loan because if you go to the bank, you can show them that you have this protection. It makes the loan payment, and you can have the benefits assigned to the lender. The rider can be up to $20,000 a month or $2 million, including principal and interest, and you can choose the elimination period. It can go to age 65 or the end of the obligation, and it helps preserve the credit rating knowing that the payment's being made. You can use it for any of these, business practice, facility renovations, increase in working capital. So with James was working for ABC Advisory for 14 years, and the owner was willing to sell. He wanted to retire, so James decided to buy the practice, and when he bought the practice, he had to take out a loan, and his monthly benefit or his monthly debt was going to be about $14,000. So in 2015, he contacted us and said, what can I do to protect it? And we said, we have a business loan protection plan. So he chose an elimination period of 90 days, and he had 9 more years on the loan. So his premium ended up being about $33.51. And, you know, he had purchased disability insurance, but he was concerned about the 8 employees that he had. If something should happen to him, he didn't want to put the burden on them, and he certainly didn't want to put the burden on his family. The next one is key person. Key person is if you have a tech-savvy person, you have a superstar salesperson, and something happens to them, this is a benefit that's paid to the company. So the employer pays the premium, they're insuring the key employee, the employee doesn't receive any of the benefits. When the employee becomes disabled, the employer gets the benefits tax-free, and they're free to do whatever they want with that money. They can use it to recruit a new person. They can use it to replace the lost revenue that the person might have been generating. So an example is Kevin. He works for a CPA firm, and he's their lead CPA and IT guru, and they chose a plan that would provide something to offset his lost income of $70,000. So they chose a 90-day elimination period. It's going to pay $7,600 for 9 months, and then a lump sum of $72,000 if he's not back after 1 year. So let's look at the impact of a disability to a business partner and how it would affect their long-term business plans. The reason this is so important is because the inability of a partner to continue working due to an injury versus an illness is a serious matter, one that's more problematic than if he had died. Additionally, it's really important to talk about this to your young clients because they have a tendency to think they're invincible. Some of the reasons they don't like to talk about it is they're too busy, they need more capital, they're not sure where to start, and 16% say it's really not a top priority. But you need to sit down with them and ask the question, what happens if you die or become disabled? You need to think about what impact it's going to have on your family, your partners, your employees, even your suppliers and your customers. But lucky for you, we have a solution. It's called Business Owners Buyout Program or Disability Buyout Program. What it does is it provides a payment to the owner in the event that the disabled one of the owners becomes disabled. The other owners can buy out their share of the business. And usually it's funded by it's written down by a buy-sell agreement, and most buy-sell agreements are funded by life insurance at 49%, or it can be funded by business cash flow at 44%, or disability buyout insurance at 17%. Those are the most common ones. So we've talked about providing your clients with individual disability and possibly getting a discount for them, and then we talked about some solutions for your business owner clients. But what are your clients that have no income to replace, or they have some unusual occupations? That's where critical care comes in. Critical care is ideal for those clients not covered by disability, maybe maxed out, they can't get any more disability. Perhaps they're self-employed working from home, like writers, or their income is erratic, maybe like a realtor, or there's no income to replace, like a stay-at-home parent, or they're retired. Obviously, they wouldn't have any income. The reason critical care insurance is important is because 4,000 Americans will hear today, you have cancer. 21 will hear you have a heart attack, and 2,000 Americans will hear you've had a stroke. 75% of healthy 40-year-olds will become critically ill. In 2016, it's expected that 1.69 million will be diagnosed with cancer, and there's 15 new cases of ALS daily. But if they had a critical care plan, they would get a check. So at this point, you're probably wondering, where's she going with this whole critical care plan? Well, here's the story of Janet. Janet came to me last month, actually via her husband. She's a stay-at-home mom, and her husband was concerned that if something should happen to her, who's going to take care of the kids? Who's going to tutor them if they need it? Who's going to get them to school? Who's going to get them to their doctor's appointments? And he said, you know, life insurance would provide a benefit if something, obviously happened to her where she died prematurely. But if she were to become ill, what am I going to do? And I said to him, Patrick, I think I have the answer. I think critical care would be a great solution. Critical care insurance provides a lump sum in the event she becomes ill, heart attack, stroke, renal failure, you name it. So he said, you know what? I'd like to look into that a little deeper. And I said, great, because your wife is a perfect candidate. She's got no income and she's not eligible for disability, but yet you know the value of all the different things that she does. And in this slide, you can kind of see, those of you who have a stay-at-home mom, you can see all the different things that she does and the value of them. And in this case, it came up to just under $119,000. Well, Patrick realizes that if something should happen to Janet, if she suffers cancer, heart attack, stroke, there's certain situations where he wouldn't want to stay home and take care of her plus the kids. He needs to be at the medical practice earning an income. One of the carriers that we work with, what's great about them is they will actually pay 3 times. So if something were to happen to her and she had a benefit amount of 100,000, she would get paid 100,000 if she had a heart attack, if she had a stroke, and if she had renal failure. And we're going to talk about that in just a minute. The benefit period can be as little as 10 years or it could be lifetime. You can choose from 10,000 to $500,000. He was smart because he put her value at 300,000. He asked me to run quotes for 200, 300, and 500. He ended up going with the 300,000, and you can see what the premiums usually average here. The one he chose is 2,570. And if something were to happen to her, if she suffered a heart attack at 44, bam, she's going to get 300,000. God forbid, if at age 48 she suffers a stroke, bam, she gets another 300. And even worse, if at age 51 she suffers renal failure, she's going to get 300,000. What's great about this particular plan is it will literally pay 3 times, but you're only paying for one premium benefit for 300,000. And the great thing about the critical care plan is it's tax-free. You can do whatever you want with the money. In Patrick's situation, he knew that he could hire a nanny to take care of the kids. It would help offset the medical bills. It could help make the car payment. It would pay groceries. He could do whatever he wants with that money. He gets it lump sum. So for him, he has peace of mind knowing that if something were to happen to Janet, he can continue with his business practice and know that the household and the kids would be well taken care of. So we covered a lot today, as you can see, and I just want to say that you're probably asking, why DI? Well, you've seen in the last hour the bottom line, all the different things that can happen. And 57% of consumers say significant financial changes would be needed if they were disabled for 6 months or more. 73% of employees in this country do not have any income protection at all. And lastly, the likelihood of someone becoming disabled due to a disabling injury versus a fatal is 240 times greater. Now, I know I covered a lot here, but there's some things that you need to know. The top 10 things that make LLIS different. As you can see on this slide, we have an upcoming webinar in June called Juno, the Goddess of Marriage and Childbirth, Time for a Beneficiary Change. These are the top things that make us different. We sponsor all these different organizations, and then these are some of the different services that we offer. Questions. I have some questions on the side here. Does the COLA start at the inception of the policy or when the claim starts? It starts when the claim, okay, it kicks in when you're actually out on claim. What slides will be available for download? That I'm not sure about. Please touch on options available when a person doesn't qualify for disability coverage. I believe I heard the only option available is the catastrophic. Okay, I just talked about critical care, so that would be an option if they don't qualify for disability. You mentioned that 45% of people have a disability during their lifetime, but what percentage of people have a disability before age 65? And can you insure past age 65? Yes, you can insure past age 65. There are some plans that will go to age 70. Just because your policy goes to age 65 doesn't mean it ends. You can conditionally renew it every year as long as you can show proof that you're still working 30 hours or more. So it does continue on past age 65. I don't know what the statistics are that have a disability before age 65. I can get back to you, Philip, on that one. Are there any other questions? Are there coverages available for people working overseas? There are coverages available. It's just that it has to be a limited period of time that they're living overseas. Generally speaking, if they're going to be there 3 years or less, we could provide them with some coverage. It just depends upon what they're doing over there, how long they're going to be over there, and who they're working for. But certainly that would be something I would, discuss on a personal basis, a personal phone call. Any other calls? Any other questions? Excuse me. Okay, I don't see any more coming in. So if there are any more, feel free to email me directly. You have my email right there, kathybilodeau@llis.com. Thank you so much for tuning in, and I look forward to hearing from all of you.